Hi, I'm Ryan Boyle, Senior Economist for Northern Trust. We're now more than a year into an aggressive central bank tightening campaign. The pace of balance sheet depletion and interest rate hikes have been far faster than anything we expected a year ago. I give central banks credit for maintaining a tight focus on the fight against inflation. As inflation rose, so did interest rates. By increasing the cost of borrowing, central banks hoped to cool demand and thus reduce the pressure on prices. After a year of wondering how many hikes are ahead, we're beginning to speculate about the other side of the interest rate cycle. How many cuts will we see and when will they start? Interest rate reductions will come for one of two reasons. Central banks meet their mandates, or they have to respond to a crisis. Central banks have assigned mandates from their respective elected governments. Nearly all are expected to control inflation. In much of the world, inflation appears to have passed its peak. Over the remainder of the year, I see several reasons to expect inflation to stay contained. The cooler housing market, reconnected supply chains, slower consumer demand, and the lagged effects of that busy year of interest rate hikes. If inflation gets back to a manageable level, central bankers may deem it appropriate to move interest rates down to a more neutral rate. Readings on inflation and employment will determine when this process will get underway. Lower inflation could be the signal to cut, if it is sustained and broad-based. Currently, services, excluding energy and housing, have experienced persistent upward price pressure, a sign that inflation is far from cured. A modest increase in unemployment and a decline in job openings would also signal that the economy is cooling and getting closer to equilibrium. The alternative impetus for rate cuts is less rosy. Central banks may need to ease off in response to financial instability, which has the potential to cause a recession. Banking problems are typically addressed through supervision and rarely elbow their way into monetary policy discussions. But recent stress has created a trilemma, the challenge of taming inflation, avoiding recession, and supporting banks all at once. Should concerns over the financial system resurface, rates may have to decline to head off a full-blown crisis. We're watching developments in the banking sector very closely. The past year has taught us to be humble when forecasting policy decisions, as circumstances can change quickly. The current range of possible paths is much broader than is typical. We'll be using a wide-angle lens to stay abreast of the possibilities in the hope of providing you the clearest possible picture.